In the last session we were discussing what I consider to be perhaps the founding principle of technical analysis, which is that in a downtrend support turns to resistance, and in an uptrend resistance turns to support. Today I wanted to round off some of that discussion and to start taking a look at how we can use our understanding of how price moves through these levels to our advantage, how we can get into some good trades and profit from our understanding of that situation. The chart that we're looking at is Euro GBP, and we can identify in this down wave, at the beginning of the down wave, there's a support level there, and one of the things that we'll notice, and this is a very common there's a very common structure as the trend direction changes, and there's lots of ways to identify that a trend direction is changing. Sometimes that directional change could be corrective in nature, which means it will last for a short while. Sometimes it can be a lot more significant than that, but one of the most common price movements that you'll see is that a support is breached and it becomes a resistance, and then you have trend continuation. That in effect is the price structure that we're looking at constantly as we're moving through support and resistance levels. If we go and mark the support levels on this chart, we can see that as price navigated its way through the levels, we have a breach of the support becomes resistance, and we have trend continuation, breach of the support becomes resistance, and we have trend continuation. Again, if we're looking at this down wave, one of the first indications that we would have had that this structure is about to change is when price returned to retest the old support level. What should have happened here was that support should have turned into resistance. It didn't. Instead we had a consolidation around that level. Price broke higher and pulled back in order to test it as support, and from there we had the beginning of an uptrend, and what it looks like is something like this. So again, like I said, very common structure, almost like a early warning system that the market sentiment is changing. If we go ahead and mark now the resistance levels, we can see that price follows the same structure through those resistance levels, and so resistance is breached, retest, resistance turns to support, trend continuation. Again, we see this level holding a couple of times, just as we saw the resistance there holding a couple of times. Over here it's holding a support, resistance is breached, minor correction here, retest, trend continuation, resistance is breached, and on the retest the level is holding as support. And then if we look again, what's taking place up here is that the support level is breached and we have a retest. Support becomes resistance. I should change the color of that so it becomes a bit more visible. There you go. Support becomes resistance, and we get continuation taking place there. So that's how price moves through these levels. As I've mentioned before, it's a very common rhythm within the market. Visually it's fairly straightforward to identify. It doesn't take a lot of effort. Now what I wanted to discuss was how we take advantage of this, and if we were to put it very simply, the principle which I like to follow is that I'm not really a breakout trader. I'm not waiting for a high low to be breached. The principle, simply put, is to buy or to sell on the retest, and this is where a little bit of common sense is required, which is that if the price is falling, then what we need to be thinking about is where should we be selling this instrument. So as you see a price fall through a support level, the thought which should be coming to mind is where can I be selling? Often what happens, and it's a very common mistake, is that as the price is falling, all the prowess of our ability to do technical analysis is directed toward trying to identify support levels, and we might be using a whole host of tools in order to do that. We might be looking at historical prices, we might be using moving averages, or some oscillator showing an oversold position, or something else, but if the price is falling, then what we need to be thinking about is where is resistance, so that we can get into a trade in line with the market sentiment, and we're going to get into that trade on a pullback. Similarly, if the price is rising and we've seen that a resistance level has been breached, even if the price has flown away from that level, really we're not interested in taking a trade until we get a pullback, and so we just wait for that pullback to the resistance level, let resistance become support, and we let that put us into an entry. What we're not going to be doing is that as price is rising to be saying, oh, where's the resistance, where's the resistance? The resistance is gone, the resistance was breached, and so what we need to be asking, and it's the most sensible question to be asking when the price is rising, is where is support? That is what will get us into the most well risk defined trades. You know, where our stop needs to be is easily identifiable. If we're wrong, then we will know straight away. It's not something that we'll have to wait forever to find out. If this level is not going to be support and it's going to be breached, then you know, clearly I'm wrong, and that's something that we can come to terms with. That's something that we can come to terms with very easily. I hope you found this presentation useful, and I look forward to seeing you in the next session.